Ever feel like your portfolio is missing something? A secret weapon for when the market gets really choppy? Well, today we're going to talk about an asset class that's often overlooked but could be exactly that. Let's dive right into the world of commodities.
So let me ask you a question right off the bat. I'm sure you've built your portfolio for growth, right? But is it built to handle the silent killer of wealth, inflation? That's a question that has become, well, more important than ever lately.
Just look at 2022. When inflation really kicked into high gear, traditional portfolios got hammered. The S&P 500 down over 19%. And even those supposedly safe bonds, they fell 13%. When your two main players are deep in the red like that, it feels like there's absolutely nowhere to hide. But, you see that empty space on the chart? What if there was something else?
What if I told you there's a missing piece to this whole puzzle? An asset that didn't just survive the inflation storm of 2022, but actually thrived in it.
Okay, so let's start with the villain of this story, inflation. It really is your portfolio's nemesis. It's that invisible force that just eats away at your purchasing power, and it creates that classic and painful double whammy where both stocks and bonds can get hit at the exact same time.
So, if inflation is the villain, who's the hero? Well, let's meet our hedging hero. Commodities. These are the raw materials that can act as a really powerful shield for your portfolio.
So what in the world is a commodity anyway? Honestly, it's pretty simple. It's just a basic good or a raw material. We're talking about things like corn, oil, copper, or gold. The key thing is that they're interchangeable, so one barrel of a certain type of crude oil is the same as any other. These are literally the fundamental building blocks of our entire global economy.
And we can break them down into a few key groups. First up, you've got your agricultural commodities. That's basically the food you eat, like wheat and corn. Then you've got natural resources that we have to mine or drill for, things like gold, silver, and oil, the fuel we use. There's a third category with financial tools, but for today, we're really focused on those first two, the tangible, physical stuff.
All right, so what is it that makes commodities so powerful? Well, it all comes down to one word, uncorrelation. I know, it sounds like a super fancy finance term, but the idea is actually really simple. Their prices just don't always move in the same direction as stocks and bonds.
I want you to think of your portfolio like a seesaw. When stocks and bonds are weighing one side down, you want something on the other side that's rising up to balance things out. Historically, during those inflationary times, commodities have been that powerful counterweight, helping to stabilize the whole thing.
And listen, this isn't just a nice theory, the data totally backs it up. The statistical measure for this runs from -1 to +1, where 1 means two things move in perfect lockstep. This low number you're seeing here, that's the statistical proof of that seesaw effect. And it happens because commodities are driven by real-world supply and demand. How much oil is being pumped or how much wheat is being harvested, not by some quarterly earnings report.
And what's even cooler is that different commodities can really shine during different parts of the economic cycle. When the economy is expanding, industrial metals are in huge demand. During a contraction, investors might all flock to gold as a safe haven. And when things are recovering, energy often leads the charge. It means you've got a potential tool for pretty much every economic season.
Okay, so you get the why. That's the theory. But what about the how? How do you actually do this? Let's open up the investing toolkit and look at the practical ways you can add commodities to your portfolio.
There are really 4 main ways to get exposure. You could own the physical stuff, but let's be real, storing barrels of oil in your garage is not very practical. You could also trade futures contracts, but that can get pretty complex for most investors. So for today, we're going to focus on the last two, which are way more accessible: ETFs and producer stocks.
So, option 1 is the simplest approach, a broad-based commodity ETF. Think of this like buying a diversified basket of a whole bunch of different commodities: energy, metals, agriculture, all in one single trade. Funds like DBC or COMT make it just as easy as buying any other stock.
All right, option 2 is for when you want to get a little more targeted. If you have a specific view on something, like you think gold is about to take off or oil prices are heading higher, you can use single commodity ETFs. Funds like GLD for gold or USO for oil let you make a much more precise bet.
Now, a third option is to take a more indirect route, investing in the companies that actually produce the commodities. We're talking about energy giants like ExxonMobil or mining companies like Newmont. The logic is simple. When the price of the stuff they produce goes up, their profits, and hopefully their stock price, tend to follow.
Just one crucial point to keep in mind here.
A company's stock is not a perfect substitute for the commodity itself. Remember, you're also investing in that company's management, its debt, and a whole bunch of other business factors. The price of ExxonMobil stock isn't going to perfectly mirror crude oil, and that is a key distinction.
Now, before you rush off to add commodities to your portfolio, it is absolutely vital that we take a balanced look here and weigh the risks against the rewards.
So here's the trade-off. On the risk side of the ledger, commodities can be much more volatile than stocks. We're talking big price swings. And their performance is also super cyclical. But on the reward side, you get that powerful inflation hedge we've been talking about, and you get true portfolio diversification.
So how much should you actually consider allocating? Now, obviously, this is something to talk about with a financial advisor, but experts often suggest a range. A more conservative portfolio might have maybe 3 to 5% in commodities, while a more aggressive one could go as high as 15%. A little can really go a long way here.
And this brings us to what is maybe the most powerful and kind of counterintuitive idea of this whole thing. Even though commodities can be volatile all by themselves, adding a small amount to your portfolio can actually lower your overall risk. I mean, that's the magic of diversification right there.
Which brings us right back to that very first question. Your portfolio is probably planned for growth in a perfect world. But after seeing how commodities can act as a shield during the tough times, the real question is this: is your portfolio prepared for reality?